All right, Janine, it's time for our main topic of the day. And on today's episode of Rockin' Retirement, we're going to talk about universal retirement truths. Now, we know, Janine, that retirement's this unique journey, right? The thought that there's this, one-size-fits-all solution. We've spent lots of time on your various podcasts through the years talking about how that's a myth. But what if there are some universal truths that can at least help guide every retiree in a similar fashion? Would that at least help out the planning process a little bit?
Yeah.
And it turns out that there are, right?
Mm-hmm. Yep. And especially if you're in retirement. If you're near retirement, you have some space to start adjusting some of these things. But if you're in retirement and right before that, you need an income plan. I mean, even if you're in accumulation mode, you really should take a look at, income versus outcome. Income, or what is it that goes into and that goes out as,
Yes.
You need to make sure you're not spending more than you earn, which the government does all the time, but we won't go there. But you definitely need an income plan, because you have to be able to factor what it's going to cost you to live, which is very difficult to do for a lot of people who are, 10 and 20 years away from. But even those who are nearing retirement, when you start to actually look at the numbers in terms of what am I replacing? I mean, typically people, the industry for years has said, oh, you want to replace 80% of your income. Well, not if inflation has been high. It's more like recently, 120%. Yeah. And so you've got to look at what's it going to cost me to live? And then how do I get the income I'm going to need from the sources or resources that I have? And that's where a lot of people have difficulty, because going into retirement and trying to do income planning is a whole different ballgame.
Yeah.
And then that leads to what other things are attached to that, all of your investments. So for most people because not a lot of people have pensions anymore, if you don't have a pension, then what do you have? Social Security.
Yeah.
And so when should you take Social Security? Why should you wait? Maybe you shouldn't wait. There are a lot of questions in that decision alone that you have to explore, because
how big of a piece of the puzzle is your Social Security going to be?
Exactly. And then, there is a tax consequence depending, but if the only thing you have is Social Security that you've planned for, then your invested assets are going to provide that income. Well, how are you going to do that? And what we know is people tend behaviorally to knee-jerk to what the market's doing, especially when markets are volatile. And because there's an independent organization called Dalbar that watches money inflows and outflows from the market. So we know behavior is probably the biggest nemesis for success in retirement. People react to volatility in not good ways. So, how you are diversified matters. So that would be item number 3. You've got getting your income plan, and then realizing that you can't time the market successfully. Nobody can consistently. So how do I make this work with my invested assets so I don't lose them? Which, if you're chasing return, you're going to affect your portfolio, which then is going to be more affected when you have a volatile market or a down market, and you also have a withdrawal plan going on. So if you're over withdrawing and the market's volatile, then you're going to deplete that asset pretty quickly. So how are you going to do the calculations, or how are you going to, structure the investments so they can last as long as you do? That's a real problem for a lot of people, because they don't really understand diversification. There's a lot of information out there about the markets and investing. Not all of it's helpful.
Yeah. And not all of it is unbiased. In fact, most of it is biased in some way, shape, or form, right? People are always trying to get you to do something.
Right. And so, like just recently, in fact, I was looking at a couple of finance sites this week, and I wish I had captured them, because let's see, 3 days ago, roughly, there was this one very big headline right in the middle of the page. So that would grab your eyeballs. And then the next day was a completely opposite message. So what's happening in the financial media is whiplash. And that's intentional, because it gets you to move, it gets you to chase, And that can be harmful to any portfolio, is if you're trying to pick winners and losers. And we know from the research that doesn't work. And so you've got, how are you diversified? Meaning, do I have a lot of the same thing? That's what a lot of people have, and they don't realize it.
People who are trying to like stock pick and time the market and those kinds of things, we started, one of our recent conversations was about AI and artificial intelligence and automation and these kinds of things that are in the market today. And that's what's really changed over the last couple of years, at least that I've noticed in just one simple way. We as humans are making decisions with our emotions and also over a period of time. We might be making a decision that takes us days to think about. Even if it only takes us minutes to think about, we're going up against machines and algorithms that are making decisions in the, trillionth of a second, right? Right. In ways that we could never dream of being able to make split-second decisions and predictions and things like that. So it's tough to win a game when your opponent is literally a step ahead of you from a timing standpoint.
That's right. And if you're an individual DIY, you do-it-yourself investor, you are way behind the curve when it comes to trying to pick and choose winners, because the institutional investors own the market.
Yeah.
So if you aren't coordinating what you're doing with basically institutional investors properly, you're just going to be constantly getting whiplash from the movements. And you're right, they trade very fast. So the idea, especially when you get to retirement, is not to do that. You don't want to be trading in and out of your account. You want a proper portfolio diversified across asset classes with proper location because of a couple things. One of them is that's how you're going to be able to calculate your income over time so that it's consistent and you don't deplete the portfolio. The other part of that is taxes. I mean, taxes are going to change anyway with tax code, but you can incur taxes by continuing to move money in and out. And then if you own mutual funds, and a lot of people do, it's still about half the market, there are a lot of taxes embedded in mutual funds. You don't see them in qualified accounts like 401ks and IRAs, but there is a tax drag, and that's because the money managers of those mutual funds have to move things in and out before it's time, if you will. And so that incurs a tax. And in 2008, if everybody remembers back that far, or 2000, or last year, was a very volatile market. And if you owned mutual funds, you probably got your composite 1099 that said you owed taxes and you didn't touch anything. And that's because they're very tax inefficient. So taxes can add to, depending on where you are in income, but that tax drag can deplete your portfolio faster.
A choppy market can cause us to mistime the market, to sell and buy when we shouldn't, and while we're doing all that, create tax problems along the way.
Exactly. So one of the things that, the value of the advisor is the sounding board, the counselor that says, do not, be disciplined, stick with the plan. We talked about this. What is your expected rate of return? What is a realistic expectation? And our job is to keep you in your seat and not jump out when the roller coaster takes a nosedive, because that's the worst thing you could do to your overall plan.
Well, that's the universal retirement truths that we are going to cover on today's episode. We could keep listing more out, Janine, but pretty good job of it right there. So as a recap, we talked about how everybody needs an income plan, no matter who you are. That's kind of universal retirement truth number one. You mentioned this one a couple of times, Janine. Nobody can consistently time the stock market. That goes right in hand with then also why you need that income plan. It's funny how each of these truths kind of point to the others as the reasons why. Diversification, essential for risk management. Make sure that you're diversifying in the way that's appropriate for you. Emotions, we can't overlook that one. Going to be your worst enemy in most cases, so definitely keep those in check. And last universal retirement truth, don't forget the taxes. Tax implications matter. It's important to keep those things in mind along the way, not just for the buying and selling of the stock market side, but for any investment vehicle, right? There's been times where people have lost out on tens of thousands of dollars because of bad tax mistakes.
Oh, yeah. And what we know from, in fact, Ernst & Young did a really big paper on this, that discovered if you can control the tax bite, it actually adds about 2% to overall portfolio performance. And so that results down the road in almost a 20% increase in the amount of retirement asset you have, which of course will then provide more income. So reducing that tax drag is really important. And a lot of people don't see it because it's kind of invisible.
Yeah.
It's embedded in mutual funds, but it can be embedded in a portfolio if it's not done properly.
Very good. Well, if you need help putting together your retirement plan and your financial future, if you are building your plan off of things that aren't stable, like these retirement truths, I mean, that's what your plan should be based off of, are retirement truths. Don't you want to be operating in a world of truth and not one of confusion and misconception, which unfortunately is kind of where sometimes the financial markets want to keep you confused. Yes. They want to keep you off balance, reacting to things, because that's how they beat you. With a more systematic process and working with someone who has a ton of experience in the financial and retirement planning world, it's going to keep you from making those kinds of mistakes. So don't hesitate to reach out to Janine Theus with your questions. You can go to theuswealthadvisors.com or give her a call at 443-718-6311. Have a simple initial conversation about your plan, kind of where you stand financially, what your goals are, and you'll be able to see if you're a pretty good fit to work with Janine or not. Doesn't cost you anything to have that initial chat, so don't hesitate to reach out if you have any questions at all.